Is life insurance taxable? It's a good question. You've probably got the same question if you're watching the video. I'm going to break it all down, how it works, when it's taxable, when it isn't. Here we go. So the shortest possible answer to is life insurance taxable is it depends. It depends on exactly what you're talking about. I'm going to walk through all of the phases and when it might be taxable and when it would not. So to start with, money that goes into a life insurance policy. Now we're talking permanent life insurance here. We're not talking term. We're talking whole life, index universal life policies, variable policies, something that builds a cash value. The premiums that go in, the money that's paid in, no tax deduction for that. So that's after-tax money that's going into the account to fund it, to fund the premiums for the life insurance policy. So we're going in after tax. As it sits in there, it starts to generate some cash value as you continue to add to it. Hopefully it's earning some gain. Depending on the type of policy, how that gain works is different, but the cash value hopefully is growing over time. As it grows, you're not paying taxes on the gains as they're staying in the policy. So you've got some tax deferral there. As the cash value is growing, not paying taxes on it as that happens. And so then what can happen on the way out? Well, there's a couple of different things. You can decide to use the cash value, or you could never use it and you pass away and it's life insurance, so there's a death benefit. The easier one to cover is the death benefit, so I'm going to do that next. Death benefits are not subject to tax other than estate tax. It's included as part of the estate, but the estate tax threshold at this point is through the roof, and so that doesn't apply to almost anyone. It's north of $10 million. And so for most folks, that's not going to be the case. So if you pass on life insurance through a death benefit, I had a policy, I passed away, it was payable to my beneficiary, they're not paying tax on that money. It's not like an IRA or something like that. The death benefit is income tax free to the beneficiaries. So what if it's money that I'm not worried about passing on? What if it's I want to use some of that cash value while I'm alive? Well, it gets a little bit trickier here. So remember, it went in post-tax, it's grown tax deferred. Now, if you're going to start to access some of that money, depending on how you access it, it may be subject to taxation. So if you're pulling out money that is existing premiums, that's sort of like your basis, that's money that was funded again after tax. So you can pull that out and there's no taxation because it's just the post-tax money you originally put into the thing. You can withdraw that money without worrying about being taxed on it as income. If you're withdrawing gains, so it's money that has been earned in the policy, typically that's going to be subject to taxes. So if you're just withdrawing the gains, you're going to pay taxes on it. Now you're like, wait a second, no, I watched this other guy's video. He told me tax-free from life insurance and all of that stuff. Apparently you don't know what you're talking about. Oh, but I do. Here's the thing. They're talking about taking loans against the cash value. So if you borrow, it's a loan is not income. If you borrow against the gains in a policy, they're not subject to income tax because a loan is not a form of income, and that can work fine if the policy is structured properly, but you have to be careful that you don't blow the thing up. So as you're borrowing against it, you have to pay interest against it. Do you have a variable rate? Do you have a fixed rate on the loan inside? Or have you pledged it to an outside bank and you're borrowing the money that way? You have to make sure that you're not going to, and when I say blow it up, I mean withdraw enough of the cash value that you now either have to put more cash into it to stop it from happening, or it just implodes. Because if it implodes, all of that money that was pulled out, now you're looking at taxes on it because it's not a loan anymore. Now you're going to have to realize some of those gains and potentially pay taxes. So can cash value from life insurance be utilized without paying taxes? Yes, if it's structured the right way and you do it the right way. If you just pull out all of your cash, no, if you've got gains in there, those gains are going to be taxed. You can't really make a gain and realize it without paying tax in our system generally. There are a couple of loopholes, long-term capital gains, things like that. I'm not talking about that for this video. Generally speaking, if you're just going to pull out all of the cash from a cash value life insurance policy and you have gains in the policy, you're going to pay taxes on those gains. You can borrow against the gains and not pay taxes, but if you do it, watch out for the structure of your life insurance policy. As you can imagine, this stuff is very complex. That's not something that you want to play around with and then end up making a pretty big mistake down the road. If you're looking at this sort of thing, find somebody that knows what they're talking about. Go through the specifics of the structure, find out inside the policy what the loan rates are at. Are they variable rates? Are they fixed rates? What are the interest crediting options? Is there a fixed interest crediting option that's greater than the loan amount, so that you can help to insulate yourself from potentially blowing the thing up down the road? Find all that stuff out up front. Don't just fall for, hey, it can earn all of this and it's going to be great and whatever, because you might get yourself in a bit of a pickle if you do something like that. So I hope I answered your question on whether or not life insurance is taxable. It depends, but now you know what it depends on. I thank you for being here. I hope you enjoyed the video, and I'll see you soon.